Hello my fellow freedom builders and welcome back to the channel. This is yet another of these videos that I actually hadn't planned making. I have always, when I enter a week, a complete plan of what I want to make videos about, but then all of a sudden something happens, and something happened yesterday and I simply could not stop myself from making this video. So for the rest of the week I will probably be making videos about strategies and performance and all that stuff, but today we simply need to address if Fed, meaning the Federal Reserve in the United States, if they are breaking the law, and if the market will keep going up forever. Now, why is this important? Well, today I am going to take a look at what happened in the market yesterday, why it happened, and I will be going a bit into details, and you might be thinking during the videos, why do I have to hear about this? But you do. If you are a serious investor, you need to know this. And in the end of the video, I will give my opinion as to if the market can keep going up at least until the election in November. So stick to the end and I will give you my answer here. Now, first of all, what happened yesterday? This just seems like the normal volatile market. Yeah, well, on a daily chart, it is a bit hard to see here because of the candle. So let's just shift into a 1 hour chart here. Now, each candle here is 1 hour. And what happened yesterday was that the US futures on the Dow started to tumble, and they really tumbled quickly. It went down very, very quickly, and then all of a sudden something happened. And then from the bottom here, let's just have a little measurement here. From the bottom here and to the top, it rose more than 7% in one day. And that is quite extraordinary, especially because there was not really any financial news. There were not any unappropriate tweeting. There were not any, all of the stuff that normally moves the market. No, what happened was another thing. There was a headline here saying Fed will begin purchasing corporate bonds on Tuesday. That is today, Tuesday, June 16th, 2020. Now, why is that so extraordinary? They have been doing that since what, March, April, something? Well, there are some details here, and before we go into the details, let me just give you a quick look at what is actually happening with the Fed, because in here, that is on the Investopedia website. I'll put a link to it below. But in here, you can see that there are all the fiscal programs and the existing Fed programs and the new Fed programs. And these are the ones we'll be looking at today. These are simply all of the help during the crisis here. And if you are kind of losing the perspective and missing the overview here, then Investopedia is giving you a very, very good quick bullet point list here of what is actually going on with all of these help programs. But what this is about, what this video about today is what is called the Secondary Market Corporate Credit Facility, also called the SMCCF. The Fed and government, they love these shortenings for all of their long sentences here, and this is what is called a letter soup. SMCCF is, as we can see here, something called a special purpose vehicle launched by the Federal Reserve on March 23rd to support the corporate bond market in phase of this virus. Now let's just have a look at what an SPV is, because that is also important. And I know you're thinking, oh no, my head is exploding, but please keep it together just for a quick while. There are some details here we need to know. A special purpose vehicle is something that is inserted in this equation because Fed is simply not allowed to buy anything else than than government bonds, pretty much. I'll get back to that in a second. So this is, if you imagine your 14-year-old son, he's going to a party and he wants to go down to the shop to buy 10 beers. But he's only 14 years old, so of course he's not allowed to buy beers. So he has an 18-year-old friend or 21-year-old friend, that he gives his money to, and the friend goes into the shop, buys a beers, comes out and hands them over to your 14-year-old son. Now you might say, that is not the intention of the law. Well, basically they're not breaking the law, not according to shop selling the beers anyway. So this is actually a special purpose vehicle that he's asking his friend to buy the beers, because then he is not breaking the law, the shop is not breaking the law, they just have this special purpose vehicle, this SPV, that is buying the beers for him. This is actually what is happening right now. Since the Fed is not allowed what they are actually doing right now, they have just made, with the Treasury Department, a special purpose vehicle where Fed is lending money into, and then this SPV is buying up all these corporate bonds that we'll be looking at in a second. So that is an SPV. That is a smart, neat little trick to do what you're actually not allowed to do and just calling it something else. All right. So this SMCCF, that is the secondary market corporate credit facility, will purchase US investment grade corporate bonds. And an investment grade corporate bond is a high quality corporate bond and bond ETFs in the secondary market. With the idea is that the banks will be more likely to lend to corporations if they know there is a strong secondary market to sell that debt to. All right. So what we see here is that it is a setup that will make sure under this crisis that the companies can go into the banks, lend some money, maybe in the form of issuing bonds, and then Fed will come riding in on their white horse in shining armor and buy up these really, really bad bonds. All right. So let's just scroll down here. We can see key takeaways. The Fed is trying to ensure banks continue to lend to corporations. Fair enough. I can understand that. The secondary market, this SMCCF, buys corporate bonds and bond ETF. That is completely new, and we will have a look at that in a second. They started buying the bond ETFs about a month ago in May, and now they will be buying corporate bonds directly. It encourages lending by ensuring that there will be demand for secondary markets. Yes. The program started buying bond ETFs on May 12th and will start buying individual bonds on June 16th. That is today. Okay. If we go down here, something interesting happens. For instance, these bonds that they will be buying, they must have a rating of at least BBB minus or the equal. That depends on what rating institution you're getting it from. But BBB minus is what is called investment grade, meaning they're not complete junk bonds. It is not the high risk bonds. But a little detail put in here, they should have this rating as of March 22nd, meaning that if they had dropped below after March 22nd, they can buy them anyway. Then they must be at least BB minus, but that is what is called junk bonds, meaning that there is a very high risk that these will default on the debt. Okay. Another thing here is that right now, this SPV won't hold more than 10% of the bonds issued by a given corporation or 20% of an ETF's assets. So that means that as of right now, they will not be buying more than 10% of bonds in a given corporation. But as we will see in a second, they are actually allowed to do a lot more than that. But right now, they are only doing 10%. But I have a feeling that that will change quite quickly. Then it says something down here that the SMCCF will stop buying bonds or ETFs after September 30th unless the Fed extends the operations. So of course they will end in September 30th unless the Fed extends its operations. And I pretty much can guarantee you that the Fed will extend its operations. If you remember that I think that was actually in September last year, Fed went in with this repo rescue mission. That was a temporary rescue mission that would run for a week or two or something like that. And then it was extended for a month and 2 months. And I'm pretty sure it's actually running now 9 or 10 months later. So as I've said many times, this good old quote is still good. And it says that there's nothing as permanent as a temporary government project. So this is what we're looking at right now. What came out in the news yesterday was this, that they would set up this, or they had set up this, but they would start buying up corporate bonds in single companies. Meaning that if a company is in dire troubles, then they can go in and support one single company. And it's not just an ETF, they can pick and choose the companies they want to, as long as they were not junk bonds on March 22nd. Now, why is that a problem? Well, there are several problems here. Let's just go into an article I found here from something called Wall Street on Parade. It is a very good website. I'll also link to it that below. And they really know their stuff. And here they're going into depth with this, but they are looking at the Federal Reserve Act, meaning the law that the Fed must obey to. And what it says here is that it has been interpreted for the past 107 years to mean that the Fed is not allowed to encourage speculation in stocks and corporate bonds by accepting either as collateral. If the Fed is not allowed to accept stocks and corporate bonds as collateral, it would clearly follow that they are not to be purchased outright by Fed either. Well, they are not. They are purchased by this special purpose vehicle that Fed puts their money into, of course, so it is Fed's money. It's just not Fed that is, quote unquote, buying the beers. So that is the basic Federal Reserve Act that over the last 107 years pretty much have stated that you cannot, or Fed cannot, buy bonds directly from companies. But, and I should say that in April, this article is from April 28th, and in the beginning of April, the former Fed chair Janet Yellen appeared on CNBC, clearly indicating that it is her understanding that Fed is restricted to buying government debt and agency debt. So what Janet Yellen's interpretation of the law was that, of course, Fed is not allowed to buy bonds directly in the market because that is what the law says. But there's more to it. In 2010, there was something called the Dodd-Frank Financial Reform, and that was just after the financial crisis, and they were doing all of these government programs. They were doing them at that time as well. And in here it says, and I will shortly leave this heavy stuff, this theoretical stuff, but we need to know this because this is important. Emergency funds, and that is a part of the Dodd-Frank revision here. Emergency funds had to be broad-based and for the purpose of providing liquidity to the financial system and not to aid a failing financial company. And I can pretty much guarantee you that when some bank in the near future will be in big trouble, maybe because they help finance the oil industry, the shale oil industry, and so on, and their bonds are really, really doing badly right now, then there will be financial institution in big trouble, and I can pretty much guarantee you that Fed will come in to the rescue here as well, breaking this paragraph here. All right, loans had to be collateralized sufficient to protect taxpayers from losses. We'll see in a second why that is nowhere near the thing here. Taxpayers will definitely lose money on this. Restricted the Fed from establishing a program of the facility that is structured to remove assets from the balance sheet of a single and specific company. Well, they are actually doing that when they are taking the loans off the bank's balance sheets. They're buying them out, so they're breaking this one as well. Mandated that any Fed facility be terminated in a timely and orderly fashion. Well, as we saw just a second ago here, then of course it will end at September 30th this year, unless of course the Fed extends its operations. But we'll have forgotten about that at that time. And then we come to the real cliffhanger here, the real explosive stuff. Require that the prior approval of the Secretary of Treasury for any facility invoked by the Fed under its emergency lending authority. Well, who is Secretary of Treasury right now? That is Steve Mnuchin. Steve Mnuchin is about as good a friend to Donald Trump as they come. And that means that the Fed's, it writes here directly, the Fed's wishful interpretation of the changes made in the Dodd-Frank is that as long as Treasury Secretary Steve Mnuchin is giving the green light for what Fed is doing, then none of the other prohibitions apply. So what Fed is actually doing right now is that they are taking all of this, putting it in the garbage can and just saying, as long as Steve Mnuchin is approving what we are doing, then everything is fine. Then we can make all of the SPVs we want. We can print all our money digitally, put them into these SPVs, and they can do pretty much whatever they like. That's how we stand right now. Okay, so back to this little issue here where their taxpayers could not lose money. In the SPVs that is running right now, although they are saying, in the beginning here at least, that they will not be owning more than 10% of the debt in a single company, then further dodges of the law clear intents will be that the SPV will be allowed to purchase qualifying bonds as the sole investor in a bond issuance. How much could the SPV buy as a sole investor? A whopping amount. According to the term sheet, the SPV can buy from one issuer, one company, 130% of the issuer's maximum outstanding bonds and loans on any day between, and then we have some dates here, meaning that if a company has an extreme amount of debt and cannot pay it, then Fed can go in, or no, sorry, not Fed, but the SPV can go in, they can buy up all the debt and a 30% extra. So they're taking over all the debt and giving the company 30% of the entire debt amount in liquidity right now. If that is not risking the taxpayers' money, then I don't know what it is. So yeah, this is pretty much where we stand. So I promised you that I would give you my idea, my take on where this will take the market. Well, as long as Steve Mnuchin, and therefore, of course, Donald Trump, pretty much can just say to Fed, we allow you to do whatever you want. And Fed, of course, want to do it. I know there have been some quarrels between Donald Trump and Jerome Powell, but we should remember that Powell is put in there by Republicans. He's actually not an economist. He used to be a banker in equities and so on. So he's pretty much, he's not a typical economist that usually leads the Fed here. But if Jerome Powell and Donald Trump sees that it is beneficial for them to keep pumping up stock markets, then they are pretty much free to do it. Of course, there can come some legislation later, or the Congress can step in, but that will be a lengthy process. So my guess is that up until November, where we have the presidential election, and knowing that Donald Trump and the government have really had their hopes high for a roaring stock market, that is kind of their thing. Donald Trump has said since the first day in office that he sees the stock market as a barometer and a thermometer that measures his success as a leader of the country. As far out crazy as that statement is, then we must assume that Fed and the government has a huge interest in keeping the stock markets up. In an interview the other day, Jerome Powell was said if it was to be interpreted in a way that they were printing money to keep the stock market up. And he said directly, yes, you could easily say that that was the truth. So Fed is admitting that what they're doing here is to keep the stock market up. So my guess is that until the election in November, it will be hard for the stock market to drop. Of course it can drop, and we saw that as well. Now we're still on the 1 hour chart here. We had a bit of a drop here, and then it keeps going up. And of course the market will be more and more immune towards these different things from the Fed. But the good old saying that don't fight the Fed still stands, because they have unlimited printing resources. And as long as there's not really anyone that stops them from the government part, well, yeah, what can I say? Then they will be pumping this bubble up pretty much until November. That is my guess. Of course, I don't know it, and there can come a second wave of the virus. There can come different things. Nobody can predict what is coming. But if nothing big happens, if the virus kind of goes away miraculously in the summer, as someone once said, well, then my guess is that Fed can keep the stock market pumped up at least until November. Of course, there are prices to be paid here, possible huge inflation on a later point, a huge fiscal deficit, all of the things that Trump was elected on stopping, but that is apparently not the case right now. So my guess is that they will be trying to pump this up, and you as a private retail investor, of course, we can have all of these thought about it must come down at some point, but let's just realize that as long as Fed is pumping money into the bonds, the stock market will keep going up. If it doesn't, I have a feeling, and this is just a theory from my own little head here, but my theory is that at some point, if the stock market really starts dropping and they can't keep it up by buying bonds, then they will actually make a new SPV, a new special purpose vehicle, and in that they will put a huge bunch of green US dollars, and they will start buying up equity ETFs, meaning ETFs that contains just normal shares. And the next step, of course, will be buying shares in specific companies. And that is the road I think we are going down of. It can sound a bit dystopic, a bit dark, but I think that is the way we are going. I think we will have a crash eventually. It is not 100% certain that Fed and the government can keep the stock market afloat until November, of course, but I am pretty sure that they will do anything in their power to try and hold their hand under this market at least until November. It is not my intention to sound like some sort of conspiracy geek here, because it's not really a conspiracy. These of course are my speculations, and I have no idea if this will actually go on until November. But as far as I can tell right now, and as far as I can hear from Powell's own mouth, then they have the intention of keeping the markets up for some crazy purpose. It is not really helping the economy. There was a lot other things they could do that could actually help boosting the economy. But right now, the stock market is in focus. So in the upcoming weeks and so on, I think we will see a rising stock market, even though it is as crazy as it possibly can be. That's all for now. I hope it made sense. It wasn't too dry and theoretically. And I hope it gave you some inspiration as to what you could do with your portfolio. Remember, it is your own decision. I'm not a financial advisor. I'm just an observer looking at the market, making my own thoughts out of it. Remember to subscribe to the channel if you like the content, and I'll talk to you again soon. Take care of yourself and your money out there. Bye for now.